Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zacks Director of Research, also our earnings expert, and our own expert on the oil industry, Sheraz Mian. And we've talked a couple times, Sheraz, about the oil market, but now you're back again because things are happening. Yeah, oil has gone back into a bear market. It's down more than 20% off its recent highs.
That's
so
right.
Everybody's like, oh, it's all bearish.
Yeah.
And that's impacting the energy stocks. So we're going to talk about them again in a separate segment.
Sure.
But some things are also happening because a lot of the oil analysts and the just the big research companies are coming out with new notes on like what to make of this oil market. And Goldman Sachs just came out with one last week, and they tend to make the headlines, of course, because they're Goldman. And they've been all over the map. They were very bearish like last year. And so I was intrigued to see what they were going to say about, what they see going forward here. And they surprisingly said that oil, they believe, will be range bound between $45 and $50 a barrel. But this all depends on what happens with Nigeria and Libya. They both have supply disruptions in both those countries. So if they start really kicking in production in the second half, then Goldman believes that the price of oil could fall further. But they see still kind of what you've said in a couple of your other podcasts about slow rebalancing, and that, unless there's some huge global slowdown or this big boost in production in a couple of these countries that have had issues, then they don't really see it, falling much below $40 or so. But yet we have a lot of some of these others, I call them the doom and gloomers, who are out there still saying the $20 to $25 range is possible, even with the massive decline in U.S. and in international rig counts, that they still believe we could see those really dark numbers.
I don't believe in the doom and gloomers. I think short of a major economic event like some of the doom and gloom predictions about China coming true, I think we have this slow and steady stabilization and construction of the oil market. I think Goldman's range for 45-50 makes sense. There is the supply aspect to it. There's the demand aspect to it. There are questions on both sides. But there's little doubt at this stage that the worst is behind us. As I mentioned, short of the demand side coming up with a big negative surprise, we may have these seasonal pullbacks like what we are experiencing right now. We are at the cusp of going past the summer driving season. We are about to head into the refinery maintenance period. Some of the offline production from the Canadian oil sands, from Nigeria, from elsewhere, that's come back to the market. And we all along had an oversupplied market. So when you had some extra barrels added to that in a seasonally weak demand environment, that's what's causing the pullback. So I believe the Goldman call is fair. I continue to stand behind what we said earlier in this podcast, which was that we should have a reasonably higher price by the end of the year this year, and the improvement should continue next year as well.
Now, I saw a lot of the oil companies in their recent earnings reports were saying they seem to be, I feel, overly optimistic, possibly. And maybe that's what they were. Yeah, they have to kind of have to be. But I saw them giving some estimates for the end of the year price of, $60, $65. I've seen some analysts going into 2017 now saying, $75, $80 into 2017, like maybe the first half of 2017. Can you see that possibility?
It's possible, and it's possible in a number of scenarios. We should remember that last year at the beginning of spring, in April, to be precise, the U.S. oil production peaked at about 9.6 million barrels a day, which was the highest we have ever had, surpassing the 1971 peak. And in June, which is the latest data we have for production, it was about 8.6. It was about 8.6 million barrels. So we have cut back by about a million barrels already, and it's ongoing. The idea is that we could stay around the June level, which is about 8.6 million barrels. We could cut back even more, and it's these unknowns of how much production comes offline in the U.S. And then the expectations of how much Iranian oil enters the global market, which will drive these prices by the end of the year. So I would call that relatively aggressive forecasts, but not totally out of the realm of ranges that one could envision.
What about all this talk I keep hearing about how we're swimming in oil? Everybody keeps talking about how there's just so much out there, and that those are the doom and gloomers usually saying this, but is that even true? I don't see how.
It is true. It is true. And what they are referring to are commercial inventories in the OECD markets. And that's perhaps true for the non OECD markets as well, but we don't have data for that. The OECD commercial inventories are at all time record levels. So I don't have the exact numbers in front of me right now, but relative in terms of the days of supply, I believe it's in the high 60s to 70 days worth of supply that's in commercial inventory. So yes, inventories remain. That has been the big issue
Yeah.
in the market the last year and a half, and it still remains an issue. And at this stage, when we have some of these shut-in oil production coming back online, I mentioned the Canadian oil sands earlier, and you have some of these refiners that shut down for seasonal maintenance, that adds to those commercial inventories, and that adds pressure on oil prices, which we are seeing at present. So yes, those to that extent, the doom and gloomers
Right.
comment is
Right.
correct. The conclusion they draw from that is not correct.
Okay. And what about the other kind of theory that's out there that once we go past $50 a barrel, say, I've usually see it around $50, that suddenly all the American producers who have, shut down their rigs and everything will spring back into action. They'll be like drilling feverishly out there, and we'll go from this 8.6 million in production you just talked about back up to 9.6, and then we'll be awash in oil again.
The extreme case of that is basically a misunderstanding of how the industry works. So it's not like the Saudi Arabia's excess production capacity, where they have everything built up, everything maintained, fully staffed, and they'll be producing 12 million, but they have the capacity for 13 and a half. Once a for-profit, publicly traded company shuts down a facility, they lay off the workers too, they cold stack the related equipment too, and those workers could move from South Dakota. If there's no work, they'll probably come to Chicago or somewhere else
Yeah.
to find work. And if those guys get into another job for 6 months or a year or 2 years, then it's hard to just leave everything behind and go back to South Dakota. So there are some short duration projects that will come back, but not everything.
Yeah, I saw some articles recently because I've been intrigued by this about, unemployment rates in the areas that have a lot of energy exposure. And Alaska, they've been talking about how Anchorage actually has record low unemployment, even though they have seen the job losses. And part of that is because they think people can find other jobs. That's one
That's right.
area. And then about 30 to 40% of the workforce there, they do believe is more transitional, I guess you could say. They're not tied to Alaska. They just went there for the job, and now that there's no job, they just left, just like they would in North Dakota.
That's
They
right.
would go to wherever the jobs are.
That's right.
And so that's why that immediate area isn't seeing, a lot of people unemployed.
Absolutely. And if the downturn in the rig count, the downturn in overall oil field activity levels, if it stays at current levels or even moderately higher levels, but way below the peak levels for, say, another year and a half, that will produce more enduring structural changes in the industry, particularly on the labor side, but also on the equipment and other supply side, which is hard to reverse in a quick order. So eventually they'll come back, but not like somebody flipping a switch and everything lighting up all over again.
Yeah, I've seen a couple other references to that. I listened to the United Rentals conference call, and they just do the equipment, but they have 5 or 6% of their revenues exposed to the energy sector.
Sure.
And they said, they get asked on every single conference call, what about energy? What's happening? And they said that they've seen it, they believe, basically bottom now. They've moved all their equipment to areas where it needs to go from the weak to the strong. So they've absorbed that excess, but there actually is no increasing demand from the energy sector, not yet, but they believe that it's bottomed. But that kind of goes to what you're saying too. Yeah, they can kind of move their equipment quickly, I guess you can say, but it's still going to take a couple months for sure to move, if there is demand suddenly in energy, to move that equipment back into that area.
That's right. And there's even more complicated equipment with the more specialized drillers, the Diamond Offshores and the Patterson UTIs of the world, who when activity are not there, they cold stack those rigs and lay off the workers. And then they have to hire those people back and put those equipment back into operation.
Yeah, I saw a good article in the Midland Reporter Telegram down in Texas. They're, obviously that's the heart of the oil industry down there. So they're covering all the things that are going on. And they talked to Oil States International, and Oil States is on the services side. Sure. They do a lot with wells. And they've laid off about 40% of their employees now. But they said they're keeping track of where everybody's going and what they're doing, because when they do need to start rehiring, you can't just be sitting there 2 years later going, okay, we want Joe back now. Well, Absolutely. Joe has gone off and he's, either maybe gotten retrained or has another better job, or nobody knows. So they said in this article that the rig count right now is at 462. They would need it to get back into the 900s before they actually had to hire again, because they would just basically give overtime to those that remain and all of that first. And then once it got into the 900s, they would have to hire. But they also believe that once it did get to that level, there would be a lot of competition for all this labor, because so many will have found other new jobs.
That's right.
And then who has the skills to come back in there and do like hydraulics or whatever?
I believe it was either Halliburton or Baker Hughes who mentioned on a conference call that 900 is the new 2000.
Okay.
For the rig
so
count.
That must be the magic number now.
They are saying that it'll improve pricing level. It'll improve some of the pressures they continue to face in their own P&L. So this 900 has some resonance across the industry.
Yeah, I guess so.
It'll help improve the outlook to some extent. It's totally dark out there in the oil patch for these service people. They don't have any pricing power, and the producers, the E&Ps, and the big oil companies, they are continuing to put pressure on them to charge less and less. So they feel that once the rig count gets to 900 and above, they'll give them some pricing power in their business.
Yeah, I saw, I looked to see what Oil States, actually did this last quarter, and they said they saw encouraging signs that activity was troughing.
Yeah.
Is that the word? For the U.S. lower 48 drilling.
That's right.
And completion activity could start to recover. But they did know, because this was last week, that, crude had suddenly tumbled back down closer to $40, and they said they wouldn't know for months if that would have the reverse effect on some of what their customers are doing. So they were a little bit cautious about, this recent pullback in the crude price.
I think the notion that the worst is behind us, that activity levels have troughed, it was mentioned by the bigger players too. I believe Schlumberger, Halliburton, those folks mentioned something along those lines as well. So my sense is that unless we get into the scenario that the doom and gloomers are projecting out there, I think this outlook holds, and there'll be a slow and steady improvement in the outlook. And for folks who are looking at the patch for investments, it'll be a function of their holding horizon. If it's the next few weeks, it's tough to make any educated decision in that time frame. But if you have a longer time horizon, there are plenty of investment opportunities in the space.
Okay, and we're going to talk about those on a second podcast coming up. So
Good.
Everybody's listening in right now, tune in to the next podcast, because we're going to give our picks on, where you should be in the oil patch. And also you can check out our other podcasts on oil, because we have a couple of them out there now on SoundCloud, both Sheraz and I talking about our picks. You can go back and see if we were right back in the day. We had one from last December 2015, and we also did at least one other one. There's been a couple other ones. So you can go back and check out those, but we'll have more updated picks coming up soon. So tune in for that.